So hi everyone, it's Susan Jordan right back again. And in this video, I want to talk about the best forex trading time frame. Okay, so what is the best time frame to trade? Is it the minute 5 charts? Is it the minute 15 or the minute 5? Is the H1, H4? Is it the daily, weekly, or monthly, or even yearly time frame? What's the best way to trade? Let's go and find out in this video. So if you've not yet subscribed to the channel, please do, and then hit the like button so that you can give me support on the work I'm doing. Okay. So the best time frame to trade. Okay. So what forex time frame should I trade? There is a direct correlation between different forex time frames and trading styles. But if you are wondering which time frame is best for forex trading, first you need to know what type of trader you want to be. Okay, so some traders such as scalpers work within very short time frames, while other traders across a longer period of time. So the best forex time frames to trade will depend up on the type of trading style you choose. So you can choose to be a scalper, and then a scalper focuses on the minute 5 and the minute 15 charts. Okay, and then a day trader focuses on minute 15 H1 and then the H4 charts. And then a swing trader often focuses on the H4 and then the daily charts. And then position traders normally focus on the daily, weekly, and so a scalper are the people who hold trades for 5 minutes, or okay, probably for minutes, and at most around 1 hour. Okay, so the day traders, they normally hold trades within that day. As long as the trade does not exceed that day, you become a day trader. So swing traders, they normally hold trades for a day, or they can even hold it for a week. Okay, uh, or they even hold trades for a month. Those are swing traders. Then position traders, they normally hold trades for weeks. They normally hold for months or even years. So it's normally very difficult. They majorly look for months and then the years. They normally buy like 5 times in a year, okay, or even one time in the entire year. Those are position traders. So right now we are going to move on to a live chart and then find out which time frame will be good for you. So make sure that you have grabbed this as a scalper, M5, M15, the trader minute 5, 15, H1 and then H4, then swing trader H4, D1 and then position trader D1W and then the month. Okay, so let's move on to live chart and then find out. All right, once again, you're welcome back. And of course, I think everyone can see this is a live chat. And we are looking at the Aus dollar in this example. And these are we are looking at a daily chart. And we're looking on a daily chart, but still we can hover through them. We have the minute 1. Okay, here we have the minute 5. Here we have the minute 15. Here we have the minute 30. Here we have the H1 time frame. We have the H4 time frame. We have the daily time frame, we have the weekly time frame, then we have the monthly time frame. Okay, so the general thing you can realize is that you have very many small time frames and then you have higher time frames. Okay, so you can see that this is a minute. M1 is minute 1, M5 is minute 5, and then M15 is minute 15. It means that each and every candle within this chart takes 15 minutes to form. So it's a 15 minutes. This is 15 minutes, and then this is also 15 minutes. Okay, and then if you go to the daily candles, it means that each and every candle you're seeing on the screen has taken one good day to be formed. Okay, so this is 1 day. Okay, and then this is 1 day. Like each and every candle is taking 1 day. That one we explained in later videos. So we want to find out what's the best time frame for you to trade. So when you look at the minute 1, the minute 1 chart, number one thing you want to recognize is that the bid and ask spread seems to be wider. For example, that is the ask line, and then this is the bid line. Okay, the prices. So you can say that this is the price and buy from, and this is the price you can sell from. Okay, so you can see that the buy price, the difference between the buy price right here is a little wider on the lower chart. Okay, we're gonna bit I don't know what's happening. So we can see that the difference between the buy and the sell price of spread is big compared on the daily charts. When you come here, the is not even recognizable at a certain rate. You can see that on daily chart the spread looks to be smaller, so the transaction cost will increase on the minute 1 or the minute 5. You can also see that it still remains bigger, so the higher the time frame, the smaller the spread looks to be on a certain time. Okay, so if you buy, you're going to buy from here. The spread is still the same, but when you look on the chart, it seems to be wider. Okay. Uh, so the other thing you can recognize is that each and every candle here is taking 1 minute to be formed, and it means that you have to look on the charts every after 1 minute. And same for H1. Okay, it means that you have to look onto this chart every after 1 minute and then to wait for a trading pattern to be formed. Okay, so the question comes to you: are you able to sit on the chart all day and wait for that 1 hour to get done, or that minute, or you can be able to look on the chart like once in a day? So there you'll be able to choose. And then the other thing, which is so crucial, I want you to note, is that the market is moving in this format. Okay, raises, there's a big gap here in this format. Okay, that is on the H1 time frame. That is how the market has moved. Okay, but then if we go on to a higher time frame, for example the H1 time frame, you can see that how the market has moved is a little difficult. It's a little difficult to be recognized like the other later on. Okay, let us look here, and then we go to Queen. This is January 24th. Okay, and the current date, we are seeing that the market is having how many retracements? Okay, just try to count that between Jan 24th and the current date. That's what we have on the screen. 24th, we have this retracement that is 1, 2, then 3, then we have this one. Those are the market fluctuations that you're going to face as an H1 time frame trader or as a day trader. But when you move on a higher time frame like that H4 time frame as a swing trader, you can see that they have decreased. That is from Jan 24th. Jan 24th starts from this 19th, this is 20th, this is 24th, and then this is 24th here. Okay, this is where 24th starts from. You can see that in the H1 time frame, you've been having periods of selling. You had something like this, but you can see that in the H1 time frame, you have something straightforward. Okay, here the market fluctuations have reduced on the higher time frame, but on the lower time frame, the market fluctuations have increased. And then when you go to a higher time frame from the H4 time frame, for example, when you look at the chart right here, you can see that you have this, which is not going to appear on the daily time frame, maybe have something like this. Okay, and when did that happen? Control F. So right here, this is going to be on the 18th. When we go to check the 18th on the daily time frame, it is going to be around here. Okay, this is 15, 18th, this is 16, that is the 18th. Okay, right here. So on the 18th, you can see that you got a sell trade on the H4 time frame, but right here you do not have a trade to go short. Okay, so you can see that the market fluctuations have decreased, but on the H4 it was something big like this. But when you look at the general rule of the day trading, the retracement is very small. Okay, so in general, the lower the time frame, the higher the market fluctuations. Okay, and then the higher the time frame, the lower the market fluctuations, and we want to avoid market fluctuations as much as possible. So all what we need is to capture this. What we need in the market, we want to avoid this. Okay, this is what we want to capture. Okay, we want to capture this, and then we want to avoid these retracements. Okay, that is what I want you to note. And still, if we zoom out, If we zoom out like here, okay, make the chart just look small. So this is what we are looking out for. This, okay, that is on the daily chart. We are looking for this. This is where we make money. And then we normally lose money when the market goes up, you buy and then it comes back. Okay. So we want to avoid these retracements. So it means that the higher the time frame, the lower those market fluctuations, these ones. So when you go to a weekly chart, you can see that weekly chart, you can see that the fluctuations reduce. Okay. So for example, here, if we mark this range, for example, from here, this drop, then we also mark up to here. Okay. Then move to a daily time frame. Between those two lines, you can see that you have this fluctuation, you have this fluctuation, and then you have this fluctuation. Okay. And then we are leaving that one, we didn't mark it. So when you go to a lower time frame like H4, the market zooms out more, you have a complete uptrend, but still you can see that this between this you have this fluctuation. Let's try to zoom in a bit. Let's try to zoom in a bit. So we want to avoid these fluctuations still. These ones, yeah, this was a bad market, you would have made huge losses there. This was a bad market, you would have made some huge losses there. And then this bad market, you would have made losses. So you can see that the fluctuations, the lower you go, the higher the many they become. Okay. So it means that you have to look for time frames whereby the fluctuations are reduced. H4 time frame it seems okay, but when you move to minute 15 time frame, you can see that the market seems to be untradable. And then I want to add you one thing, that as a trader, you make the money when price goes high and then goes like that. But if you find a market which is in this format, then it goes up and then it comes and then this is a bad market, and this is what is happening on the minute 15, like you're saying on the chart. But when you go to a higher time frame, minute 30, the fluctuations try to reduce. You can see here you have a general uptrend which seems to be clear compared to the minute 15 time frame where you have up and then bear market, up then bear market, stuff like that. When you go to the H4 time frame, again, you can see that fluctuations tend to decrease. This was seeming to be a general uptrend from here. This is what we have been seeing on the current chart. And then when you move onto a daily time frame, the fluctuations still reduce more and more. Okay, fluctuations tend to get reduced. And when you move on the weekly time frame, the fluctuations still reduce the more. Okay, and then the monthly time frame, still the fluctuation reduce the more. So you can see that here, this general downtrend we've been having on the weekly chart is simply one candle within the weekly chart, so within the monthly chart. Okay, but when you go to a weekly chart, you can see that these are series of candles. Make the candles, this is 1 2 3 and then 4. Those are the 4 weeks which made a month. And then when you go to a daily time frame, you have to count 30 candles downwards. And when we move to the H4 time frame, where that bear market happened, you can see that you are having a lot of fluctuations, so you have to avoid those fluctuations. The higher the time frame, the better. So that is the conclusion of this video. Thank you for watching. My name is Som Jordan, and I will see you in the next video. So I want to add you one thing, that the higher the time frame, the more stable the market. Sorry, I had concluded the video and talk about something. The other thing I want to talk about is the other thing I want to tell you is that the lower the time frame, okay, that's the more the news affect the market. Okay, so for example, when you look here, we want to avoid a market which has these big candles which happen at once. For example, let us move to gold. I want to show you a gold chart, and then you see what news do. So for example, here you have the gold dollar, the pair here is a very clear clear trend. When you go to the H4 time frame, of course, you see market fluctuations. And then I want to look at the H1 time frame. So when you look at the H1 time frame, for example, so news affected by the market is in a clear uptrend like this, but then still it drops quickly. So this is news which is happening right here. Those news, they affect the market. This is now news. So news disturb the market more on lower time frames. That is what you have to know. That's what I wanted to tell you, that when you see these big candles which are in opposite of the current major trend, they normally happen because of news or a change in market sentiment. But when you go to a higher time frame, there is stability and such things, they normally happen less. Let us try to scroll through the H1 charts, and then, or probably the minute 15 charts, and then you can be able to see that. So you can see these candles right here, these ones. They are happening more in a minute 15 chart. But when you go to a higher time frame, they will not happen that much. You see, this is now news right here. Okay, those big market fluctuations we want to avoid. Okay, so you can see these big market fluctuations. Okay, you can see these big market fluctuations, but when you go to the daily candles, the news affect them less. When you look on the entire chart, there is no candle which shows to be in the opposite direction of the current market trend, which is simply showing that there is stability at a higher time frame. You can see that the market looks smooth and nice. Okay, those are very rare conditions like here. Okay, and then when we go to the weekly charts, it becomes more and more stable. Okay, you can see. Okay, so you can see that the weekly chart seems to be more stable compared to the daily chart. Okay, so as simple as that. So the higher the time frame, the more stable that chart, and then the lower the time frame, the less stable the chart is. The higher the time frame, the fewer, oh sorry, the lower that the time frame, the more market fluctuations you get compared to higher time frames. And in my opinion, I would say that it's better to focus on higher time frames, starting from the daily, weekly, and then monthly. In that way, you'll avoid so many losses and you have peaceful way of trading. So thank you so much for watching this video. Do not forget to hit the subscribe button and make sure you like, you share my page so that you give me some support. My name is Jordan. And I'll see you in the next video. Bye bye.